Good morning, everybody. Welcome. Good morning, everybody. Thank you very much for joining us. Welcome to the launch of our 2021 annual survey of the AGM season of Irish public companies. So I'm Justin McKenna. I'm a partner in Mason Hayes & Curran, and I will start by just introducing those from whom you will hear this morning. We have my partner, David Mangan, who is a equity capital market specialist like myself. We're very pleased to have Bernadette O'Donoghue, who is a research product lead, Glass Lewis, with vast experience beyond the small number of companies in our little island, and with vast resources applicable to global equity markets. And finally, then we have Paul Egan, who is the chair of the CLRG, Company Law Review Group, who is personally responsible for many of the innovative company law changes in the last few years. In fact, he's responsible for company law generally, which also means that it's his fault. So as to our report then, what does our report do? We hope it has become a useful annual tool for market participants. We collate information on sources that dictate the contents of AGM circulars. We collate information published by PLCs themselves on the resolutions they put to their members and the results of the meetings they hold. And then we also comment on issues that are important in the year under review. So then, what do we say about the 2021 AGM season? 2021, a year like no other, except perhaps the year that immediately preceded it. So what were the themes that we picked out? Well, the first, of course, is the continuing Groundhog Day of the pandemic, such that we were going to run out of Greek alphabet numbers soon, or letters soon. So the largely closed and hybrid meetings of 2020 continued in 2021. Interestingly, the provisions of the Companies Miscellaneous Provisions COVID-19 Act 2020, which permitted wholly virtual meetings, were not in fact generally adopted, with most companies adopting closed or semi-closed meetings, apart from court-convened scheme of arrangement general meetings. And the reason for that is interesting. I tried to court controversy at this presentation last year by suggesting that the closed meetings were possibly not in compliance with company law. Perhaps what I might have said instead is not validly convened, not validly held, and eminently suitable for challenge. In any event, the reason I believe that the court-convened scheme meetings were held in a strict compliance with the 2020 Act is that those convening the meetings have to swear affidavits as to the validity of their convening and being held, such that no one can take any chances in relation to any technical glitch with respect to such a meeting, whereas a slightly more expansive view has been taken, I think, in general by public companies on this issue. Another theme, the Irish equity capital market continues to contract. A number of significant companies were taken private as a result of perhaps the tsunami of private equity money that is continuing to surge. So we lost Applegreen, UDG Healthcare, CPL Resources, and only one IPO so far completed of Core Energy, which is a Dutch incorporated company that came to the Euronext growth market. A company which navigated difficult CSD requirements to get there. So a little plug for MHC. We acted in this, which means that we acted in 100% of the IPOs in Ireland in 2021. Why is it that the Irish equity capital markets have failed to surge with other equity capital markets? Is it because we're small and remote, or there's no liquidity here, or no investment here? I don't know, but it's just been a notable feature. And then the final thing that we've picked out from 2021 is that the level of shareholder participation has shown a marked decline over 2020. Now, this is the first year we've noticed this, so we'll be watching this trend for 2022, and we'll give you some stats on this later. The factors which may, and I stress may, be relevant include the migration to Euroclear, the intermediated system of share ownership, which places quite a bit more process between shareholding and voting. But as against that, it's often said that particularly retail shareholders tend to merely instruct their brokers or other agents to deal with all that process for them anyway, which is a very valid point. And then, of course, we had the continued closed or semi-closed meetings, which, in my view anyway, and I think borne out by international experience, are not particularly conducive to shareholder engagement. But the raw data that we collated doesn't allow us to draw a conclusion in that respect. I do also think that the forthcoming dematerialization of all Irish shares in January 2023 will not be conducive to certainly retail shareholder involvement as yet another process-based communication. But we will look at that during the course of next year's report and try and update any conclusions we can. So I think now I'm going to hand over to David to take us through the results of our survey this year.
Yes, thank you, Justin. So I'm going to step through some of the principal results of our survey and expand on some of the findings. It's a quantitative analysis. I'm going to restrict myself to the numbers, so you're going to have to wait until Bernadette's presentation for a more qualitative review of the resolutions passed at 2021 AGMs. So starting with remuneration resolutions. 2021 was the first year in which all Irish PLCs were in scope for the SRD2 obligation to put forward a vote or votes on remuneration. Now, this is because these requirements only applied in respect of financial years commencing on or after 10th of June 2019. So they didn't apply for most companies in 2020. The first type of remuneration vote is a vote on remuneration policy. This is something that now has to be put at least every 4 years, and it need only be advisory and non-binding. So you can see that 40% of companies in 2021 passed a resolution on a remuneration policy. It compares with 52% last year. Obviously, being a 4-year vote, we'd expect this to settle down into a more or less 25% on average per year vote. And that's reflected also in the companies who put votes forward in 2021. Only AIB and DCC overlapped in both years, putting policies forward in both years. If we turn to the next slide, we can have a look at remuneration reports. This is annual report, and as you can see, we have near universal compliance in the 2021 season with the requirement to propose a resolution on the director's remuneration report. So of our sample, now if we compare the support for these resolutions compared to the policy, so the support for the policies that were proposed in 2021 was very high. 9 of 10 were over 90%, and the remaining one was above 80%. Support for remuneration reports was slightly lower. So of the 24 that put them forward, 22% received an 80% or higher approval. 2 companies had a 20% or higher vote against the resolution. We highlight this because this is the level at which a company is obliged under the UK Corporate Governance Code to explain when it announces its results what actions it intends to take to consult shareholders. So those were Kingspan and Cairn Homes in 2021. Flutter also had a significant vote against, 84% support. So Bernadette, as I say, will give a bit more background on the qualitative criteria that Glass Lewis uses in making its voting recommendations on remuneration reports. So turning to the next chart, incentive plans. There's no obligation, obviously, to put an incentive plan to shareholders in each year. And this year was much like previous years. 7 companies, 28% of the sample, proposed a resolution to approve an incentive plan in 2021, which is more or less the norm. 5 of the 7 were resolutions to adopt new plans, and 2 were resolutions to amend existing plans, very much in line with previous years and well supported in all cases, 90% plus support. So the next topic is the meat and potatoes of any AGM resolution analysis, the share allotment authorities. So the general guidance for the directors' allotment authority is that 2/3 of the issued share capital is available for an authority to issue new shares with preemption rights, plus any additional amount required in respect of deferred consideration or options. Then preemption rights, the guidance if we stick with the same slide, but just that the guidance for preemption rights is since 2015 is in line with the Preemption Group Statement of Principles that 5% of the issued share capital for an authority to disapply preemption rights generally, and an additional 5% of the issued ordinary share capital for an authority to disapply preemption rights, provided the company confirms it's intended for use in connection with an acquisition or specified capital investment. So on allotment authorities first, which in many ways is the more vanilla authority, 24 of the 25 proposed a resolution, only Datalex did not seek authority. There was poor support for the allotment authority resolution from the shareholders of Flutter and Hibernia, meaning greater than 20% votes against. It's worth noting there was also weak support, so 10 to 20% against in the cases of Curran Holmes and IRES. It's hard to know what motivates those votes, perhaps dilution concerns. But if we turn to the next slide and discuss preemption rights, which is usually where we see the action in opposing allotment authorities, certainly in the UK, preemption disapplication resolutions are the most commonly defeated resolutions at AGMs, probably because all it takes is a blocking minority of 25% to prevent special resolution being carried. Also worth noting, just as an aside, that no Irish companies in 2020 used the expanded 20% authority that the Preemption Group allowed in 2020 between April and 30th of November. In the specific case of COVID, they had indicated this was transitory, not an indication of the likely path of future authority. But as Justin said at the beginning, capital raising by Irish companies during the pandemic has been much smaller in Ireland than in our European neighbours. Now, taking the small pie chart there first, very high take-up, near universal, 24 of 25 proposed a resolution disapplying preemption rights. And then of those resolutions, 24% sought disapplication for only 5% of the company's issued share capital. Most commonly, 68% sought disapplication for the 5+5% level in accordance with the Preemption Group's Statement of Principles. Very much in line with previous years for your interest. So last year, 72%, 2019, 59%, 2018, 58%. Basically back to 2015, there's been a pretty stable majority, substantial number of Irish companies which have put forward the 5% plus 5% level. That kind of contradicts the guidelines, certainly by the most radical proxy advisor is PERC, usually, which prefers a 5% only level. Glass Lewis and ISS, the more mainstream proxy advisors, in general will approve of a 5% plus 5% in line with the Preemption Group Statement of Principles. Strangely, this was better. These resolutions were slightly better supported than the general directors' allotment authorities, and I'm not sure we can conclude anything from that at the moment. It's just to note that. Now, if we turn to share buyback authorities, as you know, a PLC needs to pass an ordinary resolution in order to be authorised to buy back its own shares by way of market purchase. And the proxy advisor guidelines here are generally, in the case of Glass Lewis and ISS, they will recommend voting in favour of a proposal to repurchase shares. That's in line with the FCA listing rules and the Euronext Dublin listing rules guidelines of 15% maximum in any given year and a price of not more than 5% above the average trading price. And the resolution must be annual. It can't last more than 18 months. Now, the PERC guidelines, again, an outlier, they'll recommend voting against general authorities to buy back shares unless the board has set out a clear, cogent, compelling case demonstrating how it would benefit long-term shareholders, and also that the directors are not conflicted. So these were very well supported authorities, all above 95% for all companies. The levels at which companies sought authority, principally 10% was the limit, 19 of the 23 at the 10%. Only 2 of our 23 companies that sought approval for the 15% maximum level. Okay, if we turn to dividends, in 2021, like 2020, was another year of fewer final dividends proposed at AGMs than in normal times or in good times. 10 companies, 40% sought approval, very similar to the level last year, but below the number of companies. It will usually be more than half of companies we would expect to see approving a final dividend. And like last year, there were withdrawn dividends and withdrawn resolutions. 3 companies, like last year, withdrew a proposed dividend resolution prior to the holding of the AGM. Only 1 company actually sought authority, CRH, to make scrip dividend offers. If we turn to the next chart, the next theme is directors' resolutions. So Bernadette is going to address some of the factors which go into a decision by Glass Lewis to recommend a vote for or against a particular director. But I'm going to concentrate on gender diversity this year as the theme. The target of 33% female participation on boards was recommended in the UK by the Hampton-Alexander Review, which has now come to the end of its cycle and is due to be replaced by a new review for FTSE 350 companies. There's also the Irish Balance for Better Business Review Group, which has recommended a target of 33% female participation on boards of Irish listed companies. Finally, this is just turning to the proxy advisors. Glass Lewis applies the standard of 33% for FTSE 350 companies. If not, they will recommend a vote against the re-election of the chair of the nomination committee. Now, Glass Lewis, which is the only proxy advisor that actually publishes a separate Irish proxy guidelines, it says that it expects there should be no all-male boards of companies listed on Euronext Dublin, at least 1 female director. PERC only covers FTSE 350 boards and sets out the same target of 33%. ISS likewise, and at least 1 company on the board of an ISEC 20 company, very similar to Glass Lewis. So on the face of it, our chart for female representation looks like a job done for Irish companies. But if we dig behind it, of course, our sample is a mix of some companies that are UK listed, London Stock Exchange only listed, some that are members of the FTSE 350, some that are members of the ISEC 20 index only. So when it shakes out, it's not the case that, for example, 33% of the directors of boards on listed on Euronext Dublin have, or 33% of directors are female. If we turn to the next slide, we actually see the breakdown of, at board level, the number of boards that have 33% or greater female representation, and it's actually only 52% of boards of Irish incorporated listed companies on the London Stock Exchange and Euronext Dublin. So 52% have met that target. And when you compare that to the performance of the FTSE 100 companies, 2/3 of them are now at the target. It's worth pointing out that 2 companies in our sample have had no female directors, Aminex and Datamex, in 2021. Turning to the positive side, as far as achieving parity, actually 50% gender parity, 6 companies were at or near gender parity. And when I say that, I mean They either had 50% or greater female participation or were one board appointment away from achieving it. So we're talking about DCC and Greencore, both of which had met 50% parity, and IRES, Hibernia REIT, AIB, and Ryanair, which were one director away from achieving it. Now, if we turn to another routine resolution on the next slide, the authority to convene an AGM on 14 days notice, which has been required since the SRD1 amendments. Of course, the AGM standard for notice is 20 working days, which is now housed in the FRC guidance on board effectiveness rather than the code itself. I should say that Glass Lewis is generally permissive of these resolutions, so long as companies provide an assurance that that the authority would not be used as a matter of routine and only where merited, and they expect it only to be used where there's an exceptional need or urgency. ISS is similar, and PERC stands alone as being against such resolutions and expecting the 20 working days standard will apply to EGMs. So 72%, very much in line with previous years, seeking this authority. No fall off in companies seeking this authority over time. Generally well supported. Only 2 companies failed to receive 90% plus support, but they were close. If we move on to the next chart, resolutions to amend memorandums and articles of association. Standard thing that comes up from time to time. Perhaps we're slightly surprised to see 4 companies, 16% in 2021 proposing these resolutions, given that all companies had an opportunity and in fact did amend their articles of association at the migration EGMs, which were held in early 2021. So 4 companies very much in line with previous years for amendments to articles of association. Grafton Group PLC, which had some shareholder opposition to the means of holding its AGM in 2020, in 2021 proposed an interesting resolution to amend its articles of association for the purpose of enshrining a shareholder rights addendum to its articles to facilitate holders to continue to exercise certain rights, company law rights that were no longer exercisable directly as a result of migration, depending on how shareholders held their shares. Likewise, similar small amendments in other companies, FBD, AIB Group, and supported by very large minorities, 99% plus majorities in favour of those amendments. Now, if we turn to the next slide, the appointment, we'll move on to the timing of AGMs. The most popular days for holding AGMs really unchanged. Wednesdays and Thursdays are by far the most popular, principally due to the fact that proxy submission deadlines fall 48 hours in advance of the meeting, and they don't exclude weekend days, which I think is regarded as an oversight in the Companies Act. So generally, companies will try and avoid a proxy cutoff time falling over a weekend. It's worth noting that some in 2021, as the result of migration, some proxy deadlines were slightly extended for holders via the Euroclear bank system, and that there is now a different record time for meetings. If we move on to the final slide, the most popular month for AGMs remains the classic April-May AGM season. That's interesting that there really hasn't been a huge disturbance given the large variation in the way AGMs have been held over the past year, 2 years, that the companies in general have stuck with the same month of the year, or give or take, as the previous year. And I'm actually going to bring in Justin now to discuss a final slide. He mentioned it earlier, the fall off in participation at AGMs. So Justin, do you want to take this one? You're on mute.
Thanks, David. I mentioned at the start that we didn't include Euronext growth or AIM companies in the survey. And the reason for that is because it's not really possible to get the same level of information. But actually, it would be very interesting to see what the effect of, or what the current level of shareholder participation in those companies would be. There are a number of smaller such companies who often have very low shareholder participation anyway, and some of them had trouble organizing the frankly bizarre 1/3 quorum threshold imposed for the purposes of migration EGMs. And but if you look at the main company, the larger companies, the drop off in shareholder participation in some instances has been really quite marked. In some instances, you can explain that by reference to a preponderance or a large number of retail shareholders in their shareholder base. Maybe if you'd flick on to the next slide, please, Sinead. Okay, sorry, go back to the previous one. Apologies. So if you look at for example, AIB, the banks, AIB, Bank of Ireland, and Permanent TSB, their level of participation has been markedly lower. And there are a number of others. If you just look at them one by one, the level of participation in 2021 has dropped off a cliff. One of the outliers, in fact, is Ryanair, and it's difficult to understand that, except that maybe flick on to the next slide, please, Sinead. So this is the voting instructions included in the Ryanair Notice of AGM. There are 7 pages. There's to stress there's nothing whatsoever wrong with this. This is technically beautiful and, in fact, captures all of the requirements applicable to how shareholders must navigate the voting requirements in the new age of whether they are certificated shareholders, Euroclear bank participants, or holding via CDIs and executing their instructions via Broadridge. And in Ryanair's case, they have the additional unfortunate complication that shareholders have to complete a nationality declaration because as an EU listed airline, Ryanair has to ensure that it has the right proportion of EU registered shareholders, and has processes in place to effectively must have processes in place to disqualify non-EU shareholders above the relevant level. But as you can see, if you're a retail shareholder, this level of instruction is something that, unless you simply have a relationship with a broker and you say, can you deal with that for me, please? That's just mind-boggling. And as I say, it's a mere reflection of the way the market has developed. And I think that is, from a shareholder engagement perspective, from a retail shareholder engagement perspective anyway, it's not a positive development. We'll be watching, as I say, that trend from next year on. I think that concludes. Next slide, please, Sinead. Yeah, sorry, this is the chart I wanted to show you a moment ago. So again, you can just see some of the differences in terms of numbers of shareholders. So, for example, smallish drops: Smurfit Kappa 70 to 60, Grafton 63 to 44, and some really very large ones, as I've mentioned. So, and I don't want to overemphasize the point, but there has been a very marked change in 2021, and we'll be looking at it again in 2022. Next slide, please, Sinead. And now I'm very pleased to introduce Bernadette O'Donoghue, who will take you through her thoughts for the 2021 AGM season and beyond. Thank you.
Thanks, Justin. Hi, everyone. As Justin mentioned earlier, I'm the research product lead at Glass Lewis, and I've been leading the UK and Ireland research teams here for a number of years. So through this presentation, I'm just going to walk through some trends from the past AGM season that we identified. We'll walk through our recommendations and the voting outcomes, and I'll also touch on our 2022 policy guidelines. For those of you that aren't familiar with our policy guidelines, our UK policy guidelines have been released a couple of weeks ago. And if I'm correct, I'm pretty sure our Irish ones were released yesterday, so they should be on our website now. We will cover our policies as they pertain to the ISAC 20 companies or Irish incorporated companies listed on the FTSE 350 index. However, the recommendation slide that we'll get to in a couple of minutes will actually include all Irish incorporated companies up to November 2021 and the entire FTSE 350 up to July 2021. So if we move to the next slide, we're just going to kick off with some trends. And on the next slide, we will touch on gender diversity. I suppose diversity as a whole topped most conversations in the lead up to the AGM season, and it remained as a core topic throughout. If we dive into gender diversity, as David mentioned earlier, the Hampton-Alexander review set a target to have at least 33% women on FTSE 350 boards by December 2020. And the Balance for Better Business set a target of 33% women on ISAC 20 companies by 2023. In this regard, prior to the 2021 AGM season, we updated our UK guidelines to clarify that we'd recommend against the chair of the nomination committee at any FTSE 350 board that failed to meet the 33% target, or any other main market London Stock Exchange listed company that comprised solely of directors of one gender, unless some mitigating factors were set out. We also updated our Irish policy guidelines to clarify that the Euronext companies should compose directors of both genders, and that the ISAC 20 companies should demonstrate that they are working towards the Balance for Better Business targets. So this actually turned out to be the largest vote driver for the FTSE 350 election of director proposals, and we recommended against 17 directors on FTSE 350. And that's a major escalation from 2020, where we only recommended against one director, and that was at Everest PLC. However, it didn't actually lead to any recommendations on Irish company boards in 2021. We did find that 59% of the Irish large caps, which includes FTSE 350 and the ISAC 20 companies, or the Irish incorporated companies listed on FTSE 350 and ISAC 20 companies, didn't actually meet the 33% target. At the date of their AGMs, Glenveagh Properties had 14% female representation, whilst Greencore were leading the way with 55% female representation. And I suppose just some factors that we do take into consideration where companies haven't met the 33% target, particularly at FTSE 350 companies. So if there has been a recent resignation, for example, or if the board consists of 4 or fewer directors, or if there's a firm commitment to increase diversity in the near term. Our policies for 2022, however, they remain unchanged in this regard. If we move to the next slide, we'll take a look at ethnic diversity and board skills. So ethnic diversity has become much more prominent in the corporate governance space in the past 12 months particularly. However, disclosures in this regard can be quite lacking, particularly across European markets. There's no consistent data provided, and the lack of publicly disclosed information makes it difficult for us to provide an assessment in many of the markets. However, this isn't so much in the UK, given the Parker Review targets to have one director of colour on FTSE 350 boards. So the disclosure in this regard is improving. In the UK, for our policy guidelines in 2021, we expanded our analysis of the FTSE 350 companies to highlight the company's disclosure around their progress against the actual Parker Review targets. So we weren't making a determination, we were solely relying on the company's disclosure. And as you'll see from the chart here on the right-hand side, 92% of FTSE 100 companies and 48% of FTSE 250 companies actually provided sufficient disclosure for us to make an assessment against their performance against the Parker Review targets. And of those FTSE 100 companies that did provide disclosure, almost 90% of them achieved the Parker Review targets. From 2022, we'll expand our analysis of ISAC 20 companies to include an overview of disclosure around board level diversity of ethnicity. And we may also recommend against the chair at any FTSE 100 company only that do not achieve the targets, or if they fail to provide disclosure as to why they haven't achieved them, or a succession plan outlining compliance in the near term. In addition to gender and ethnic diversity, we also provide a skills matrix of the non-executive director representation of both core and director skills at ISAC 20 companies and FTSE 350 companies too for a number of years now. And it's similar to the matrix which is displayed on the screen here, and that's from Ryanair's 2021 AGM proxy paper that we published. We attribute the skills based on the individual company's disclosure. So again, we rely solely on the disclosure provided by the company, either in a skills matrix or their bios, for example. And we also highlight if the company has actually provided their own skills matrix. However, where we're unable to ascertain how the key skills are represented on the board, here we'll provide additional commentary, including any rationale provided by the board. So for example, if there is no environmental or social skills on the board, this is something that we will highlight for our clients. However, if a company addresses the lack of such skill on a board, we will also include some sort of rationale provided there too. We move on to the next slide, please. Here, we're just going to touch on some general remuneration trends that we identified this year. And as expected, the decisions in light of the pandemic were high on the agenda. Most decisions made by Irish companies were generally in line with the approach taken by their UK peers. For companies largely affected, any salary cuts and freezes were implemented, or no payouts under the bonus plan were the most common decisions made. And going forward, our COVID guidance, which is still available on our website, that is still relevant in addition to our updated policy guidelines. So we still expect those companies which were and continue to be largely affected by the pandemic to take a prudent approach to remuneration, and all decisions made should be made taking into consideration the overall stakeholder experience, so both employees and shareholders too. And some things that we look at is the use of government support, resumption of dividends, furloughs, share price recovery, just to name a few. Another trend that we see year on year among Irish companies is legacy founder share schemes. So these are usually plans similar to like a value creation plan, where large payouts are made subject to generally a share price hurdle and no further performance conditions beyond that. At Glenveagh and Curran Homes, these are actually coming to an end in 2022, and they were replaced with more standard long-term incentive plan structures. There has also been a widespread commitment to reduce pension contribution levels in line with the Investment Association guidelines, which is to reduce the contributions of incumbent executives with that of the rate of the wider workforce by the end of 2022. Just one other trend is regarding the restrictions at banks. So I'm sure you're aware of the current restrictions of the 500,000 salary limit and the effective ban on variable pay. And following Bank of Ireland's CFO in September, it resulted in a renewed debate about whether the restrictions are still fit for purpose or not. And the CEO of Bank of Ireland actually said that the CFO's departure highlighted the challenge that REM restrictions represent for Irish banks in both attracting and retaining talent. And this is a similar concern that we've seen around, COVID and the pandemic. And AIB's chair actually stated that the bank had become a training ground for competitors following their departure of both the CEO and CFO within 2 months in 2018. This is actually something that we're currently reviewing, and we hope to release a paper in early next year where we'll just look at a holistic appraisal of the pros and cons of the restrictions in this regard. So we can move to the next slide, and I'm just going to jump here into Glass Lewis's recommendations and the voting outcomes. So on the next slide, we look at our election of director recommendations. As I mentioned earlier, gender diversity led to the most director recommendations in the FTSE 350, where we recommended against 17 directors. Beyond that, poor remuneration practices contributed to the second highest number of againsts. And particularly, just a little bit of background here, particularly since the maintenance of the Investment Association Public Register in 2017, where all companies who either withdraw a proposal or receive greater than 20% against will be listed on the register. We have seen a larger escalation of poor remuneration practices to Remuneration Committee members. And, you know, in the case of Glass Lewis, we've been escalating concerns regarding, you know, insufficient response to shareholder dissent, year-on-year poor practices. And it was a large focus in 2022, and we continue to believe it will be so again in 2021 and going forward in 2022. Next up is our policy regarding chair tenure, which led to 9 against recommendations. In cases where we recommended against here, this would be largely due to the lack of a definitive timeline for chair succession. So following the implementation of the 2018 code, after non-compliance with aligning with the pension contributions with the wider workforce, chair tenure was the least complied with of all the code's provisions for the second year running. This year, we found that 44 FTSE 350 companies reported non-compliance. However, 20 of them had actually achieved full compliance by the date of the AGM. And in those cases, the majority of companies would have availed of the flexibility which is actually offered under the code to extend the chair's tenure beyond 9 years for a limited period, or, you know, in such cases, it's typically to facilitate succession planning or develop a diverse board. For the Irish incorporated companies, we recommended against 5 directors in the past 2021 AGM season, with committee composition being the main driver. So we recommended against 3 directors on this basis, 2 for non-independent directors serving on the audit committees, and 1 for insufficient remuneration and nomination committee independence. We can jump on to the next slide where we look at the remuneration recommendations. So in the past year, we recommended against 3 remuneration reports and 1 REM policy at Irish incorporated companies, and that's up to November this year. The remuneration policy was at Irish Continental, where the CEO has a legacy contractual provision, and he appears to be eligible to receive unlimited payouts under the bonus plan. However, similar to our recommendations of FTSE 350 companies, remuneration reports, quantum-related concerns remain quite high. At FTSE 350 companies, the use of negative discretion, including adjustments to in-flight awards, were our largest rec drivers this year. However, this was expected given the decisions committees had to make in light of the pandemic. And the top 4 of the highest votes against of FTSE 350 remuneration reports, 3 of those were actually defeated, but the decision or the dissent here was largely related to committee discretion, or it also incorporated an element of discretion too. Or FTSE 350 REM report against recommendations were actually slightly down this year. So it went from 7.5% in 2021 versus 9.9% in 2020. And our policy against recommendations saw a significant increase, where we recommended against 17.9% of the FTSE 350 policies up in 2021 versus 4.3% in 2020. If we move to the next slide, we'll just take a look at some of the voting outcomes. I'm aware this slide might be slightly hard to read, but if you have any questions, feel free to post them or we can follow up afterwards. But here we've just outlined the voting outcomes and the likely concerns of individual proposals which received greater than 15% at the 2021 AGMs. The most common proposals, as expected, is the election of directors or remuneration proposals. Those labelled here as other unique concerns, those include instances where the company haven't actually addressed the dissent in the AGM results announcement beyond committing to engaging with shareholders ahead of the 2022 AGM, or where we've been unable to ascertain the exact cause of dissent. The general concerns here are similar to those that we identified at FTSE 350 companies, with quantum and potential overcommitment topping the concerns. At Grafton Group, at the date of the AGM, the percentage of female directors on the board sat at 29%, and senior management level was at 12%. In this case, we were actually supportive of the nomination committee chair on the basis that the most recent appointment was a female director, albeit it was 14 months ago, so the start of 2020, and given the initiatives adopted during the year to improve senior management director. However, we did have the caveat that if we didn't see an improvement by the 2022 AGM, we would recommend against the nomination committee chair at that point. Since the AGM, however, the company has actually commenced a search to appoint an additional female director. So this should increase the percentage to above 33%. For the share issuance proposals, typically we find that unless there's been a large issuance like a cash box placing in the past year, the against votes are largely driven by the US or South African shareholders or other overseas shareholders whose policy is routinely to oppose these resolutions. In general, for all proposals which receive greater than 20% against, we will be looking at their response and the actions taken to address the concerns raised by shareholders at the 2022 AGM, and this is in line with the UK Code's recommendations too. If we move on to the next slides, we will just do a quick dive into ENS. So on the next slide, I will touch on the board level accountability of environmental and social oversight. So this is another thing that we've been tracking in Europe for a number of years now, and identifying how boards carry out their responsibility for the oversight of environmental and social issues. So we believe that the board should come to its own conclusions about how it conducts its oversight duties of ENS topics. But it is important that they clearly disclose this to shareholders. So again, we rely on the publicly disclosed information by the companies in this regard. So in our view, the disclosure helps shareholders to understand where accountability lies in the board and assist them in engaging with boards on their oversight of the ENS topics. We've noted that European companies are getting this message and are improving their disclosure of board level oversight. As can be seen on the slide here, the majority of Irish large caps and the FTSE 250 provided sufficient disclosure for us to ascertain which mechanisms they have in place. Whether it be a standalone ENS committee, the entire board, designated executive, etc. And of the Irish large caps, we found that Irish Continental and Grafton Group were the only two companies where we couldn't determine based on their disclosure. However, Irish Continental appeared to be working on their disclosure, and Grafton Group did have some disclosure in their annual report, but it just wasn't clear enough for us to determine the actual accountability. As with all major topics that are discussed at board level, we believe it is imperative that companies provide clear disclosure on how the board itself oversees the ENS topics, in particular providing detail to the extent in which the themes are overseen at committee level, the skills and the experience that the directors have in this field, which ties into our board skills matrix, and how the board is staying on top of this constantly growing and evolving area. For anybody that's here today that's particularly interested in this topic, we did conduct a joint study with NN Investment Partners, which goes a step further to examine the relationship between companies chosen ESG supervisory structures and their ESG performance as a whole. So one of the biggest takeaways from this study was that companies do not disclose how the board carries out its oversight duties generally, and they generally have a lower overall ESG performance. And the full study is available on our website, and I can circulate afterwards if anybody is interested. And then just moving to my last slide, I'll just finish up on ENS metrics under incentive plans. This is something that we've been discussing with a lot of companies in the past 12 months. And we have actually updated our 2022 policy guidelines to clarify our approach in this regard. So we don't have a requirement for the inclusion of the metrics, of a specific metric in any incentive plans. And we do believe that they should be afforded flexibility in whether they use it under the short-term incentive plan or else a long-term incentive plan. However, where they are included, we're not prescriptive in the type of metrics, similar to our general approach to all performance metrics. However, we do believe that they should actually be linked to the company strategy. And as you can see from the slide here too, in the charts, they are more common under short-term incentive plans. However, we are seeing an uptake in the introduction of ENS metrics under LTIPs, and we expect to see this increase over the next couple of years. And with that, I will turn back to Justin. Thank you.
So again, I did that, the noob trick of staying on mute. Thank you very much, Bernadette. That was really, really insightful and really interesting, and a fantastic snapshot of the last year, and I look forward. So now we are in the Q&A session, and we have quite a few questions coming in, and we may not get to them all. We'll do our best, but with the permission of the seminar, in fact, I don't need your permission because I can just keep going, but I hope you'll allow me to indulge myself by asking a couple of questions first. Paul, this one is for you, and it's I'm going to explain a thought process and ask you to comment on it, which is a slightly not brilliant way to ask a question, because you'll have to pick the nuggets of wisdom out or nuggets of question out of it. So we've seen a decline in shareholder engagement, and I know there are company law policies that are subject to the overall EU Capital Markets Union project, but is there any way to encourage our law or to change our law to encourage shareholder engagement, as the UK is currently looking to do? Are the optional provisions included to allow shareholders to still exercise company law rights post-migration, useless, just a cul-de-sac? And can we improve? I mean, if you look at a company with 50% shareholder engagement, a 12.5% shareholder who is active, an activist, can block a special resolution. But if that drops to 25%, that activist pretty much controls the company. Can we do anything to improve that? I mean, I speak here as both a poacher and a gamekeeper.
Well, I think that we can divide the rights that shareholders have arise under Irish company law. There's some distinct ones there, and there are shareholders' rights that arise under European law. When it comes to engagement at meetings, essentially the voting methodology is clunky, and there's this extra set of procedures whereby there isn't privity between the share owner, if I can call it that person, and the company. Now, that ought to be improved by the use of websites and electronic voting and what have you. But it's clunky. That needs to be tidied up. There's also an issue about those weekend hours that David alluded to, those being included in the computation of time. And without going into it in depth, there's a disincentive to shareholders voting where a meeting takes place on a Monday or a Tuesday. And that reluctance has, if you like, infected the perception of the Irish equity market, such that some investors perceive Irish companies as ones where there's no point in voting, because to do so may impede my ability to trade my shares more readily than I'd be able to do in another jurisdiction. But as I'd say, if we had a couple of hours, I'd outline the fundamentals of the issue.
Well, I think I'm glad we don't have a couple of hours, although at another occasion I might take you up on that. Bernadette, one for you, please. Do you see any major divergence in compliance with recommendations in Ireland versus the UK, or even a major difference in emphasis in issues which are important in Irish versus UK AGM materials? And there's another question for you as well, which I'll just give at the same time. given the preponderance of closed and virtual AGMs that have taken place, what are Glass Lewis's continuing views on those?
Yeah, of course. So in terms of the first question, I would say overall, there's probably no major divergence in terms of compliance. As you mentioned earlier, or I think David mentioned earlier, we do have separate Irish guidelines ourselves, but as many other proxy advisors actually apply similar standards as those of FTSE listed companies. So I do believe that a lot of Irish companies have similar standards to those of UK companies, you know, in terms of compliance rates with the UK code. I would say it is pretty good versus UK companies, or, you know, the standard of corporate governance in general is much better than that at European companies, at least. You know, Central Europe seems to be a little bit behind, where Irish companies tend to be meeting the same standard as UK companies. With regards to the closed meetings, obviously this has become a norm in the past 18 months given COVID, and prior to this we would typically recommend against any proposal. So in the UK, as you know, companies need to submit their amendments to seek approval for virtual meetings only. So in such cases, we were typically against those. However, given the need this year or in the past 18 months to hold these meetings, we did update our guidelines and we are supportive. However, we do look for certain assurances, such as, you know, to outline how shareholders can participate at the meeting. And if we see those assurances, we are supportive.
Thanks, Bernadette. We are about 3 minutes from the scheduled end. We might run over for a minute or two if there are questions that are need to be, anybody wants to send any last questions, we'll give them a quick look. Question for David. Do you consider that share buyback resolution is included just because companies can do so and not because they have any reasonable prospect of exercising the power?
It's a good point. We haven't tracked how many times buyback authorities are actually used, which you could do from CRO filings. But I think the impression is that they're there along with disapplications of preemption rights, just because or just in case, and that in general, share buyback authorities are not routinely used or used on an annual basis. But that would be something that was interesting to track as well.
Thanks, David. A question for myself, actually. Do you consider that resolutions passed at closed non-COVID Act compliant meetings could be challenged? I kind of hate to be drawn out on this one a little bit, to be honest, but I'll preface this by saying this is not legal advice, nor is it a playbook for activists. But there is certainly a danger. And I think that for a shareholder to come out after a meeting would be slightly more difficult. But if a significant shareholder expressed concerns in advance of a meeting and sought interlocutory relief from a court, based on the Chadwick challenge, Michael Chadwick challenged Grafton's AGM last year on the basis that the notice provisions, this was prior to the Companies Act 2020 provisions, didn't comply with the Companies Act, and effectively he lost the case, or was not granted relief on the basis of a balance of convenience, such that only he and one or two other shareholders, which were not a major block, were expressing concern about the process. So if you apply that logic, if you had a significant block of shareholders expressing concern about the process in advance, you'd have to say there's a fighting chance. As regards challenge afterwards, I think the courts would be disposed not to overturn a public company resolution if there had been a very significant shareholder vote in favour of the relevant resolutions. But that's not to say that the technical point could not be made. So my answer to the question is yes, possibly. And then I think we have a lot.
Actually, just on that, to be fair, to Irish companies, the specific phrase "closed meeting" was almost universally not used. There was some variation of "strongly encouraged," "not to attend," "may not be admitted if they do attend," were used. But the vast majority, it's almost not worth tracking, provided for a minimal attendance of the quorum and a one-way broadcast, audio or video, without interaction. So effectively a closed meeting, but the phrase wasn't used.
If I could comment on that as well, Justin, in 2 of my meetings that I organised, which were open meetings, I put in, you put up the slide there of the 6.5 pages of Ryanair notes. Well, at the end of the notes of one of these meetings, I put in that public health guidelines may require the attendees at the meeting to stand outside the building where the meeting takes place. Anyway,
I think that's a fun to test before the courts, Paul, but it's better than nothing. Yeah, I mean, a number of meetings that I attended, there were, in fact, 2 of them, there was no process by which shareholders could get into the meeting because it was in a room in a building with nobody was going to let them in. So, I think if somebody tried to show up and was not permitted to attend, then that would strengthen their case. Anyway, let's hope we don't have to run that one. And Jordan, the last question I think is for you. Do you accept mid-year submissions from listed companies which would set the scene for divergence from preferred norms? Or, for example, extended tenure of an independent director?
Yeah, so in this case, we don't accept submissions. So we rely on publicly disclosed information. So any information that is in the public domain, we will take into consideration when we are writing our proxy papers and submitting or recommendations. However, if it's a case of we missed something, for example, that is in the public domain, then we will take that. If the company reaches out to us and tells us this has been updated on our website, or an RNS announcement, for example, anything like that, we will take into consideration. And if it warrants us to update our report, if it has already been published, then we will do an update outside of the period between the notice of AGM and the AGM itself. So particularly this time of year, we do a lot of engagements with companies. So, in those cases, we outline our policies and what we see as best practice. So if there is anything that we cover in those engagement meetings that we believe is quite important to our recommendation, or maybe the difference between a for and an against recommendation, we will encourage the company to disclose that publicly, because we can't actually take anything from those meetings that's not in the public domain into consideration.
Thanks very much, Bernadette. Again, thank you very much for your insight and for giving that insight to our participants and our audience today. I think that concludes our webinar for now. We've answered all the questions I think we have time for. I don't want to take up too much of your morning. So again, thank you very much for attendance, and we look forward to seeing you next year at the same event.